Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Michael Oliver of Momentum Structural Analysis. How you doing today, Michael?
I'm doing well, Darrell. How are you?
Doing good, doing good. You're one of the most trusted voices in this space, especially a lot of your calls have been on point with silver and many of the other equities. I mean, the Brazilian equities, I mean, they started breaking out as well. And so you're a voice that I think is very important and people want to hear. So I'm just curious how are you viewing last week's action on a momentum basis?
Yeah. Well, when you look at short-term stuff, which is basically what that was, in other words, when we broke down, really it was one day. Think about it. It was Friday, and then we got a minor follow-through today, but basically one day. When you look at long-term trend factors, technical stuff we look at, momentum, it was merely a storm without breaking anything. And there's no structure it broke, no trend. It didn't even jeopardize. Frankly, there are no real developed momentum, what we call momentum trend structures, that are anywhere nearby. And normally, and I'd say normally almost 90% of the time, whenever a market makes a top of significance and lasting, or a bottom, you'll be able to look at a momentum chart, like a long-term momentum chart, where you measure price, let's say, oscillated in relation to a 3-year average, or oscillated in relation to a 3-quarter average, or something fairly long-term. You'll see structure on the momentum chart that says, oh gosh, there's a line, I better not break. And almost always, when a top is made or a bottom is made, you'll find that the breakage occurs not very far in time or price from the high or the low. This occurred, for example, 2011. We peaked in September, I think it was. We turned major bearish in December and then in January 2012. Okay, a couple months off the high, a couple $100. And in fact, it labored for another year before it really fell apart. That's gold I'm talking about. Mm-hmm. And but the structure was, if you looked at the momentum chart, you'd say, good grief, any idiot could draw that line. But it wasn't evident on a price chart, but it was a momentum. Same with the bottom. 2015, after the 50% bear market, gold bottomed. And when you looked at the annual momentum chart, not the gold price chart, it kept just staircasing down a little bit. It slowed up. But you looked at the momentum chart, there was a chart pattern there that you said, good grief, look at that ceiling. It's 3 years wide. You keep going the same level. When you broke through, it was February 2016, mere $90 off the price low and 2 months after the price low. Whereas when we look at the charts now, gold or silver, and run any long-term study, there's no nearby momentum trend structure to even break. Mm. And so we think it is merely a violent jiggle in the middle, and I suspect it won't take a long time to recoup from it, meaning you might be in new highs next month or so. The issue is to see if it continues right now or not. And you start with today. Let's check it out, see what's happening. Get through the next day, then the next day. If all of a sudden you start oozing back up into that range, then you can wipe your brow, and it was a one-day phenomenon, really. Anyway, that's what we see there. And no, we did not call that break, and there's a reason. But we run very short-term momentum charts, like day-to-day action, which is what everybody seems to be preoccupied with. We saw a trend structure that broke Friday, early morning, and said, oh, I'm going to go down. But you'd had those same type of breakage points when you run the short-term momentum that occurred every couple of months. And usually the consequence is, oh, you get a bad day, you dust yourself off, and then you're back up again. This one was different. Not because of anything big it broke, but it broke daily structures, which meant, short term. But it was deep. So, no, we did not anticipate the depth whatsoever. And we don't want to cry out to our subscribers all the time every time we see a little twitch that says, oh, we're going to drop for a day or two, because then you scare everybody out of the market. But anyway, right now our assessment is wipe your brow. It's probably a one-day phenomenon. It didn't break anything. It's just noise in a very thin atmosphere. And I don't think it's an indication of sustained downside.
Yeah. Yeah, thanks for sharing that. So, I mean, obviously the move downward, I think it was, for silver, it was a historical move. Like it was the most it's ever moved in a day. I think since the 80s or something of that nature. I'm curious so there's a lot of different theories as to why this happened. Some people are saying like, oh, it's the banks. Some people are saying like it's the fund managers who, have to rebalance their portfolios by February. Some people say it's the Iran thing. There's so many different narratives out there, right? And so like
every day there's all that stuff out there.
Yeah. And so I'm just kind of curious, many people have been calling for triple digit silver for a while, and we've hit that, and so that's a huge milestone. Some folks are kind of wondering like, okay, is this the top? Was this the top? Did I miss my opportunity to sell? Obviously silver came down to 75. I mean, it was at close to 120. And so I think that's probably the question that's on a lot of people's mind was, did I miss my opportunity to sell? Was this a 2011 where it hit 48 and then didn't rebound for a number of years? And so just curious in your perspective there.
Yeah, well, it was confined for half a century in a range from $4 to 50, okay, back and forth. That's where you're going to stay, man. Meanwhile, gold had blown out the 1980 high in 2011. Silver didn't. And then it blew out the 2011 high, coming up through 1920 a couple years ago. And boom, boom, massive gains. You could even look at a chart of copper. Don't laugh. It stayed in a range from the 70s, 80s, 90s to about late 2005. Copper was selling for 50 cents a pound to $1.50, 50 cents a pound to $1.50, like silver was for 50 years in a $4 to 50 range. Okay, copper was in a similar old reality. This is 2005 now. We're going back. Late 2005, copper finally broke up out of that range. Took it a couple months of struggle, but definitively you could say, okay, finally it's up out of that range. Within a couple quarters, it quadrupled in price up to $4 plus, from 50 cents to $1.50. And then, there were sell-offs after that, but it didn't come back to 50 cents or $1. It had a range of, average price probably $3.50 or $4. Like 4 times the height of the prior 50 year. Lead did the same thing in 2007. How come silver is supposed to stay in its half-century range when nothing else has? Okay, so it finally broke out. And if we look at the copper and the lead charts back in 2005 or lead 2007, when it broke out, within several quarters, you quadrupled the price. And it wasn't like a broad base metal explosion. It was copper, and then a year and a half later, it was lead. And then when you look at gold, repeated massive new highs. And silver is contained. Well, there's some explanations as to why that mistake has occurred. But when markets make pricing mistakes, they get into a range, let's say excessively too high for too long, like a stock market bubble, for example. When they go down, they often go way more than to correct for that. If they should drop 50, they go 80% down, like NASDAQ did in 2002. Why should silver stay confined in the $50 range? Well, it broke out. And here's 2 simple methods of determining, well, where might you go? If you look at an arithmetic chart, which is what people punch up on their screen, dollar on the side, dollars on the side, but not logarithmic or ratio scale. You see this $4 to 50, $4 to 50. You broke out, but when you measure the thickness of that perfect rectangle and do the orthodox technical analysis thing, you got a range, call it $45, $5 to 50. We call it 0 to 50 if you want. Add 45 or $50 to $50, and that's your swing objective, the thickness of the prior range. Well, you'll remember back a few weeks ago, we had a struggle going on for a week or so in the low to mid 90s. In other words, there were a lot of sellers there saying, hey, we've met the arithmetic swing objective. I'm getting out. Okay. And then all of a sudden, boom, got 121. So it's evident now, okay, getting to 121 means the old arithmetic ratio or arithmetic swing objective was invalid. Okay. But when you put silver on a logarithmic scale chart, a ratio, and you measure the dimension of that 50 half-century range, from the bottom of that range to the top of that range was a 10-fold gain. If you bought silver for $4 or $5 and it went to 50, $4 or $5 went to 50. Wow, 10-fold gain, back and forth. Okay, now look at the mama market, gold. During that same time, it had 8-fold gains, but they exceeded prior gains. They didn't stay capped. So if you look at each of the bull markets, like the peak in 1980, the peak in 2011, they were 8-fold multiples. And right now, by the way, gold's recent high is only a 5-fold multiple from the bear low. So it hasn't even matched those yet. But in the case of silver, if we do the ratio scale and do the same, well, what's the thickness of the range? Add it to it. It says $500. Don't laugh. Heck, if you know, maybe it's been restrained too long. Maybe it's way too cheap in relation to gold. That's a measurable fact. Maybe it's way too cheap in relation to its own reality. It's way too cheap in relation to the degradation of the money unit. Look at an M2 chart. Look at this growth decade by decade. If silver matched the 1980 high, I haven't done the math. I bet it's like $400 or $500 just to match.
Yeah.
1980. So talk about, oh, was that the top? Even using simplistic methods, no. By going way beyond the arithmetic goal, it's saying, hey, maybe I'm going to the ratio scale goal. Well up in the 300, 400, 500 range. That's what we think is about to happen, and we think this is simply a midpoint gut kick, not a top.
Yeah. Yeah, I think, I'm always on social media, just kind of engaging sentiment and such. And there's a lot of people that think that the chart just needs to go straight up, like the price needs to go straight up with no pullbacks or anything.
What world is that?
You know?
No.
So, yeah.
The other issue is, what's your point of entry? If you're not a trader now, okay, forget the trader. You know, he's in and out every week, so his reality is week to week, okay. But a guy who's an investor, our last two major buy signals for silver. Now, originally, back February 2016, we said gold's turning up and silver, that was the bottom for silver. Okay, fine. But since then, we gave a couple other entry points that we considered good investment grade entry points based on momentum breakouts of silver and based on its spread relationship to gold. It was when you plot silver month to month versus the price of gold, and you plot that chart, and what we do is we divide silver into gold, express it as a percent. So early last year, for example, silver was 1% of gold. Now it's up toward 2%. Okay, nice move. But historically, if you go back a long way and plot that chart month by month, you'll see that for 10 years, there was a ceiling on that relationship at a very low level. And we cleared that in November. And when we cleared that and silver broke out versus gold, in other words, no longer the dog, I'm going to lead now. Okay, that's what silver said. That was $50.
Yeah.
And boom. Okay, what happened since? Okay, so if your entry level was back in June of last year, where we had our first buy at $34.79, or at that $50 level, yeah, you gave back some profits, but you didn't get anywhere close to your average entry price. So again, point of entry is very important, and it probably affects the way a lot of people are thinking about this right now.
Yeah. I mean, even the correction we had back in, what was it, October? I think, I had jumped back in and started buying silver at 45,
Yeah. Well, you were dumb, see? No, you weren't. That's right, it worked. You bought weakness. Admittedly, this is sharper than even we expected, but we did expect somewhere in the middle of this clock, and we set our clock as of the November close, meaning when that spread relationship of silver versus gold breaks out, of such a clear structure, you'll get a gusher. And whenever that's happened before, usually it lasts a couple quarters, where silver has had its breakout. It says, whoosh, I'm going to regain some reality versus gold. We're only starting month 3 of what's likely to be a couple quarter explosion. And again, harken back to the copper move and the lead move I mentioned. When they broke through their old reality, a couple quarters later, quadrupled, So that's where I think we are. It's just, yes, it's scary. All we're looking for now is stabilization and some sign that we're coming up out of here, not going back to the highs. That'll be a late issue. But somewhere in between here and there, we're going to come up with some numbers that says, oh, yeah, that was it. If you're not in, this is a good time to buy,
Yeah. Yeah, nothing's fundamentally changed either, so that's that's a really interesting thought,
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Looking at the miners, right? So the miners sold off significantly. Many of them just got pummeled. And I'm thinking, okay, well, they're producing, they're getting the metal out of the ground, they're selling them at these current high prices, and they're factoring in like all-in sustaining costs. It varies for the different metals. But I'm thinking like, okay, people are selling these miners are going to be, raking in the cash, and so, I was kind of wondering about that. What do you think about the miners?
I think we favor the miners over gold, and there's a level, though, that we haven't broken through yet. What we do is we measure the XAU index, which is the Philadelphia Gold and Silver Index, but it's miners, okay? It goes back to the 1980s, so you got some history on it. And we plot it in its relationship to an ounce of gold. And if you do, and you go back to look at 1980s, 1990s, 2000, until 2008, for several decades, if you divided XAU into an ounce of gold, you'd end up on average, above and below, a range of 25%. It reached up to 35% at one time, and its lows during this multi-decade period, when you plot the charts like a box, okay? We're in the 17, 18% level. You broke through that in late 2008, and you collapse that spread, meaning the value of the miners to what they get out of the ground, okay, to 4%. Now think about that. Something that had lived in an average price versus the thing it gets out of the ground, gold or silver. It went to 4%. We don't need miners. We need gold, silver. We don't need the miners, right? Okay. That chart is screaming at you, hey, you think I'm going to go to zero? And so since 2014, you can plot a range on that same relative performance chart. Beautiful little box. And it's like from 5% up to 8 plus, 5% up to 8 plus, 5% up to 8 plus again, intra-month, last month. Right now it's back below 8%. But if you get much above the top of that range, and we think this third assault on the upper end is probably the one that's going to break out. So it didn't break out last month. But you get up above the top of that little box. Again, visualize that as a chart. When you break out above that beautiful technical range, there's nothing to stop you, technically speaking, in terms of the value of the miners to the metal they get out of the ground, until you get up to 17 or 18%. Which is to say, to go bump the bottom of the floor that had existed for decades. So you go from, boom, you could double the miner's value relative to gold. And I strongly suspect that's about to occur and will show itself this year. Probably the breakout I'm expecting next month or so of that spread. And when those spreads break out, like the silver did back in the November close, look what happened to net price over the next 2 months. It went berserk. Expect the same from the miners. So you're right, And there's 4 miners coming up with silver miners coming up in the first 2 weeks of February with earnings for the biggies. That report will be based on what? Fourth quarter, right? Okay. Go back and look at a silver chart. Where was it during the last quarter of the year? So, that's what they get out of the ground, therefore their profits are, et cetera. Average $50, okay? Somewhere either side of 50. Right now, so far in the first month, our average price is, well over 100 average price now I'm talking. And if we stabilize here and then sort of work our way back up so that February and March we're back up toward 100, 120 again, then your average price for the new quarter is going to be about 100. Okay, double what it was before. So the guys who look at earnings and say, wow, this miner's making a lot of money at $50 last year. Golly, gee, that's really good profit. Because remember before when we were at 50 in 2011 and 1980, you collapsed from it quickly. You didn't stay there. So you never got an average price up there. This time they had an average price in the fourth quarter of $50 or so. Wow, so the earnings have to look real good. Imagine what they look like if this quarter has an average price either side of 100.
Yeah.
So if you're looking at that as a factor, whether you should tell your clients to buy silver miners or gold miners, you don't have any excuse now not to say yes, based even on the fourth quarter earnings, much less what looks like could be evolving for the first quarter. You get the point. There's a fundamental reason, too. They're underpriced in relation to that which they get out of the ground.
Yeah, for sure. Yeah, I've been definitely scooping up some miners over the last couple of days and such. I do think that there's a lot of opportunity there. And so are you, obviously not every miner's going to, outperform or whatnot, but do you see like this, because the metals, they ran first, they typically run first. And so doesn't the metals usually lead and then the miners typically?
I think the reality will hit people. And a lot of people don't like to invest in, let's say, silver futures or call options on SLV or, they just want to buy miners. It's a stock in their stock portfolio, and they're haunted by certain memories that are false and also brief, like that 2008 collapse in the miners, which happened to concur with the S&P that month. But at that point in time, the miners, relative to gold, were actually breaking down on that spread relationship I talked about, where for 3-4 decades they'd been average 25%. Well, in September of 2008, they broke below the bottom of that whole multi-year performance range versus gold. This time it's just the opposite. They're cheap in relation to gold. They're cheap in relation to the stock market. They're cheap in relation to everything. And people have just been dismissing them. And yet when you look at the earnings based on what's the average price of silver last quarter? What's the average price of silver now this quarter, or gold? How can you dismiss them? Well, finally, portfolio managers and the financial planners and so forth will have to say, yes, Mr. Jones, you're right for asking me about the miners. I kind of agree now. You can put that in your portfolio. Why? Because the earnings look great. So there may be a whole new wave of public buying. That's what I'm saying. Like especially when these next earnings reports come out for the miners in February, that start to turn heads. And if anybody does a relative study of miner value to the metals, geez, it's ridiculous. You want to buy cheap? Buy cheap.
Yeah. I think which all-in sustaining costs, it doesn't have, it's not perfect, but because there's a lot of different factors. But I believe for silver, it's between 20 and 25 for many of the larger producers. And then also, I think gold is around 1,700. 1,700. And so just thinking about how elevated the price of the metals are, and the longer they stay elevated, the cash is just going to be just raking in, so
Well, especially if they find out that this break was not the top and you start firming back up and all of a sudden people say, gee, I wish I'd bought the break. that's when they're going to realize, no, the miners aren't going to collapse either, and they're still undervalued. And what we're watching is that technical relationship, because it's very clear, very definable, and when we get a breakout over the top of that 11-year wide technical range on the performance chart, it says miners are going to lead, and probably with a sucking sound on the upside very rapidly. And it, in part, public appreciation, because people looking at earnings, a lag metric, but still fine,
Yeah, for sure. So what's the S&P telling you right now? Obviously, it's been elevated for a while. We had a little dip on Friday. And so I'm just curious what the S&P is telling you.
Yeah,
on the
we
chart.
think it's been topping since January and February of last year at lower levels than it's 15% below here. We think it's part of a broad, at least year-wide topping process, similar to what happened in 2000, what happened in 2007. There's a broad year-wide topping process, including teaser new highs of double-digit percent. But long-term momentum says no, get out of this beast. View this as topping. However, on an intermediate basis, starting in November, you'll notice if you look at a price chart of the S&P, it's come up towards 7,000 for like 6 months now, pushing up in the 6,900s, just plateaued there. It won't break down, but it also just won't surge anymore. It's just dead almost, but steady. They tried again this morning, take it down, corked it back up. Now, last month we traded over 7,000, but like for an hour, okay? So then they took it back down. We're pushing the upper 6,900s as we speak. Our work shows that since November, we think that the market needs to go up over 7,000 more credibly and spend some time in getting there. Okay, so we measure from November, that's okay, November low, December, January, now into February. I'd like to see the S&P get up at least 7,050 to 7,100, maybe even higher, fine. In order to satisfy certain intermediate factors that say you need an upside breather before you start down again. And so far, every time there's an attempt to break, it seems to hold, which pleases us, because I want to see it go up there and make that new high where, you see on financial TV, oh, wow, new high, S&P 7,000, blah, 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 blah. Also, here's just a off-the-side fundamental. Markets don't top with dark news. Usually later you say, oh, golly, that's why. Okay, now I understand. .com top. Everybody was a believer. It labored. And it wasn't until 2001, after laboring all during 2000, NASDAQ started down. It finally went down 82%, okay? And then people said, well, golly, I guess it was overbought, blah, blah, blah. But here we went down last year on a headline story that had not been an issue for 15 years of the bull market bubble. Tariffs. Trump came up with the tariffs. That's a brand new issue. People got scared, okay, rightly, so they sold into the market on a headline. And if you go back to that April low, what caused the rally initially? Trump said, oh, 90-day pause. People said, oh boy, party is on again. They bought it up. So it's like a little puppies being teased with cookies. Okay, take it down, I want to take it back up. And now the Supreme Court has heard in November the tariff issue. And they've been waiting and waiting to get that decision out. And I have a suspicion they're going to say no in some way. Full no, part no, whatever. It's enough to kick him in the knee and make people think, oh boy, the tariff issue's off the page. Now, they come out on February 20th, I think, is the next expected Supreme Court speaking. They can come out anytime they want. But I think they know they're sitting on history here, and they know it's a key issue for the markets. And they never get a chance like this very often to put their foot forward and actually impact something other than some legal decision. You know what I mean? Actually have a place in history. And I got a sense that they're going to want to say no. With enough votes. In which case, if you think that was the issue, and that's all you breathe and worry about, is the tariff thing, which is a mistake, because it's a bubble regardless of that, okay? It's a bubble going to break for reasons that are already built into it over the years. If they come out and say no, and you have a party on the upside, that's when I think you might make your top. Have that little party where you say, oh boy, it was just a bad dream. And then the market surges naturally, a bit. And then if it starts down, it doesn't have a, quote, reason to go down. That's the ideal way to turn a market down, with happy faces, and the bad thoughts are out of their mind, because the real bad thoughts are already embedded in the market. Anyway, that's a speculative thought. We'll see. But I'm kind of hoping that we get that issue off the page to where then there's no reason for it to go down. So why is it going down? We'll see.
Yeah. I mean that's like a Black Monday,
I don't think it'll be a crash event either, by the way, when you go down. Mm-hmm. There's levels we see that you could crash the market, but they are well below where we are right now. They're not as low as that April low, which was 4,800 in the S&P. But we've got numbers that hundreds of points above there that if you get there this year, you might crash. But we're not even near those levels now, meaning that if we do top and start to roll over, I don't see it being a crash event off the page right away, if at all. Mm-hmm. It could be an arm wrestling type of debatable issue, where bulls, bears don't quite know who's in charge. So no great emotion, no panic, and yet a downturn. That's kind of what we're expecting. But right now, I'm cheering for the upticks on a technical basis, because I think it would help us get to the top.
Yeah, for sure. Yeah, and with the whole tariff thing, I mean, I don't know how they're going to refund all of that if that decision were to come out. But I'm sure, I could see markets rallying because companies have a hard time with future planning, based on, these tariff one day, tariff one not this day, So I could see that being bullish. I'm curious in your take on the dollar. So President Trump had come out and said he wasn't necessarily concerned about the dollar. The dollar fell. We saw gold and silver move up significantly. And then also we have the emerging market ETFs, at least the Brazilian EWZ, start to break out. Mm-hmm. And so just curious in your perspective on the dollar and emerging markets.
Yeah, dollar. We turned bearish on the dollar index in March of last year. Price then was slipping down. It got to 104.21 dollar index now. That closed that month. It then dropped fairly quickly into April, May, down into the 96, 97 area, dollar index. And what's the dollar index? It's really 70% of it is weighted by the euro primarily and then the yen. So it's an inverse of the euro and yen. Okay. Anyway, it's not the real value of the dollar, okay, in terms of buying power. That's decaying all the time. So is the yen, so is the euro. It's just that on a relative basis, one piece of paper versus another. But you broke annual momentum trend structures that if you saw the annual momentum chart, not the price chart, and go back to 2010, you see a trend line that's so clear that a kid could draw it with a crayon. And you broke that in March last year, and you dropped sharply afterwards. And then you stabilized for almost a year now, where you're just above 100, down in the 96s, back and forth, going nowhere, but just teasing both ways, but quiet in a range, so there's no volatility really. Last month's close, Friday's close, was sufficient on price charts now, which had not broken their uptrend going back to 2010. Mm-hmm. Momentum already had back early March of last year at 104. Price closed low enough last month where if I were plotting a monthly price chart of the dollar index going back to 1980, you slip below it, finally. No noise, no headlines, just, oops, I'm below that line now. So even that line of defense, the price chart, joined with momentum. Now, we think the dollar's probably going down to challenge and maybe take out the 70 level it saw back in 15 years ago. But its correlation, by the way, the dollar index versus gold is like none. You go back, if you're investing in gold and you're based on the dollar index, what's the dollar doing, okay? In December of 2015, when gold made its low at $1,050, the dollar index was about 1 point higher than it is right now. So for 15 years, it's been above there and below that level like this. And right now we're trading about where we were in December 2015 when gold has since quintupled. Okay, so to correlate gold's moves with the dollar, not very good. Sometimes you'll get short-term coincident moves, inverse moves. But I think basically it's the big move in the dollar that will likely help, not be essential, but help gold in this process going forward. And I think the dollar slipped off that edge at last month's close. So at this point, we're fully negative on the dollar. I don't expect it to crash, but I could see a significant down move. Now, the other factor, you mentioned Brazil. Brazil reflects the commodity complex. EWZ is Brazilian ETF in US dollars. That's why I ran that report. The Bloomberg Commodity Index is cheap in relation to its own historical prices. It's a well-balanced index of energy, grains, base metals. You know, it's a good index to watch. Last October, Bloomberg was coming up through 106 on price. We said, that's it, breakout. It's resuming. It's a second major up leg. The first leg was a 2020 to 2022. This one, from a higher low level, is starting the second leg. It's since gone up over 120. Right now it's having a pullback today. But we think it's now in a new major bull leg. And when we look across the spectrum at the subcomponents, like the grains, wheat also just broke out last month on quarterly momentum. Crude oil just broke out on quarterly momentum. So a lot of its components are saying, yeah, me too, okay. Well, this impacts underpriced, commodity-based economies, Brazil being an ideal one. And sure enough, when we ran the study of Brazil's long-term momentum, it was like an overlay of the Bloomberg. So from an investment perspective, I think not only are the monetary metals the best place to be, but secondarily, I'd be looking at assets that are dirt cheap historically. They're low versus their own price history. They're low versus the relative pricing to the S&P, low versus everything you can measure. They're low, off the page low, almost free. They're turning up. And so I think it's a good place to look within the stock market at those subsectors that don't correlate to the stock market but are commodity correlated, like oil related, base metal related, grain related, fertilizers, and so forth. So anyway, I think that's a statement to be made about the commodity complex joining gold.
Obviously, dollar going lower, Brazil's breaking out. Do you see any other emerging markets breaking out versus? Because obviously, if Trump wants a lower dollar, interest rates going lower and such, typically emerging markets benefit from this. And so, just curious if you see any other.
I think the main wind for these commodity economies or even semi-commodity economies will be the rise in the commodity complex, because the prices are very cheap in the grains. Oil super duper cheap. I mean, look at its own price history, 140, 130, with 60 something, okay. So don't claim it's high, So it's got plenty of room to run based on cheapness alone. They don't need news stories. But we looked at Brazil because it was more pure in terms of being highly correlated to commodities. So forth, they export, what they export, and so forth. Other economies that might be linked to that are more mixed. So we didn't run studies on them. But emerging markets in general, which of course includes China and so forth, and probably Brazil. I'm not sure if it's in EEM or not, but it's not a bubble. There was some stock markets like Shanghai Composite. You go back to 2009 bear low. When we made a bear low, they made one. Okay. And you look where they are now, well, they're like a double and a half from where they were then. Okay. So, yeah, over 15, 16 years, they've gone up some. Okay. We've gone up 12-fold S&P, 20-fold NASDAQ. Okay. No comparison. We're a bubble. They're not. So any downside you're going to get, even in commodity-related countries. Now, in the case of Brazil, it looks like up in price, not just relative better than the U.S. But when the U.S. breaks, when you look at some of these lesser markets that have not become bubbles, that, you know, like emerging markets, that, you know, you think what a par investment that's been. They look like one. If they do go down, they're not going to go down like the S&P. So if you want to put a spread on and go a global neutral, you can short the S&P and buy emerging markets, and it doesn't matter whether emerging markets go down some. It's the difference. Okay. So I think that it's a better place to be. But in the case of like Brazil and pure commodity plays or stocks related to commodities, I think that's a far better place to be. And in fact, you'll get a net uptrend, not just won't go down like the stock market, but it'll actually go divergent from. And in the past, you can see, you go back and look at like an XLE chart, for example, the broad energy sector ETF, and look at an S&P, and there's hardly any correlation. So you can have a down in the S&P and XLE can go up. So you don't have to be concerned about that issue. But I think it's a good place to be looking as an investor, especially for a good entry-level position that's with low risk and high potential reward. And it's not a trade. I'm not saying it's going to explode in 6 months, but it's the kind of thing that I think over several years you might be very surprised and comfortable owning that part of reality.
Okay, got it. And then lastly, there's been a lot of charts going around about oil silver ratio, oil to gold ratio, and oil being kind of the laggard of the commodities to break out. And so just curious in your perspective on oil.
That's the word we've been using for months, the laggard. Back in the 2020 to 2022 move, which, by the way, peaked 3 weeks after that war began in Ukraine. So that didn't take it up. That basically topped the commodity boom. Oil was a leader. It was doing better than most other commodities. This time around, it's a laggard. In fact, it just came out of the sewer hole, you know, a month or so ago. It was $55. Now we're trading about 62, 63. So when you look at it historically, just itself, what's $60 for crude? Well, you go back in time, a decade or so, you say, well, monetary inflation, degradation in the buying power of the dollar, has, you know, gone up 80%. So, you know, et cetera, in reverse. Oil hasn't gone up to reflect that, and oil in relation to its own highs is less than half the price of its prior two highs, 140, 130. So it's cheap. Okay, that's one argument. The other is we had a momentum technical breakout at the end of last month, getting above 63 on a close, end of the month. And that broke, if you look at a price chart of oil, WTI crude, and go back 5-6 years, you won't quite see why that was important. You'll see, yeah, nice uptick, but, you know, no big deal. But when you run the momentum charts that we have, you broke a very clear, massive, multi-year structure that had defined all the rally highs, capped them off, and you went poof, punched through it, and you broke out last month. So there's no excuse for that. There's no need. You don't need a headline. You simply have cheapness, like you said, in relation to silver, in relation to gold, in relation to commodities, in relation to the S&P. You know, sometimes things go up because they perhaps shouldn't have been down so long. And they made a mistake that way, and therefore the upside is merely correcting for a prior mistake the other way. They don't need a reason. Okay, get the point. I think that's where oil is right now. And it wouldn't shock me that even hopefully without a headline, to give you an excuse, that we could see oil up in the mid-90s in a quarter or two. Well, you know, that's not even challenge the 2022 high, which is 130. But that would certainly jolt people pumping gasoline in their car. You know, I thought you were going to keep gasoline low, and suddenly it goes up 50% from 60 to 90. You know, that would cause some heads to turn. Wouldn't shock me if it happens. The technicals say oil's turning up.
Okay. All right. Well, that's good to know. So that means there's still a lot of opportunity out there, even regardless of the recent sell-off that we had this past week. There's a lot of opportunity, and we are still in this commodity cycle. So that's what I'm taking from this.
Yeah, I think that's where we are, and you have to reorient your thinking about, should I own the stock market or should I own commodity stocks? Should I own gold, silver, or should I own stocks? And all the technicals tell us, no, that relationship's over. Gold's now asserted itself versus the stock market. In fact, that only occurred in November. The spread relation to the S&P broke through a structure. Same with silver versus the S&P. Just broke out a couple of months ago. It's not over, it's just starting. So yeah, it's a time to reshift your assets. Yeah.
Yeah. Well, appreciate that. Michael, where can people connect with you, ask questions, subscribe, all of that?
Well, they can get more detailed analysis with specific numbers instead of general comments at olivermsa.com. And we cover all the broad markets we've been talking about.
Okay, sounds good. Well, appreciate you for coming on the show, Michael.
Darrell.
Yeah, thank you.